Okay, so let's look at some schemes, if you like, for small business. As you can imagine, VAT, the HMRC want to be flexible for smaller businesses, and the first one is referred to as the annual accounting scheme. So this is a scenario where businesses can make a kind of payment on account and then have a balancing figure. And typically, just to make things easier, as opposed to your 3 monthly VAT returns, only one VAT is submitted each year. The conditions are that your income cannot exceed. So you expect this turnover. Traders can join this scheme if the VAT exclusive taxable turnover, of course excluding capital assets, of course, is expected to be less than or equal to 1.35 million. But as you can remain in the scheme, but then if somehow you now get to a point where you look back and you have outgrown that, then you must return to the normal 3 month cycle. Grown that by where your last 12 months are 1.6 million. So those are the conditions that you can go, same conditions as a cash accounting scheme, which we'll see next. But the key point is that you can go for this thing where you choose to look back at the last 12 months. So it says here you can make 9 monthly payments on account, basically from month 4 to month 12 of your year. And this is based on 10% of your last year's VAT liability, and then you make a balancing payment. So there's one, you can see their advantages. There is one return, and you're making these fixed monthly payments, and then you have a balancing payment. So let's look at a question to kind of highlight this picture. Let's highlight this picture here. Sorry, I'm just trying to get there. Here we are. So we have here, it says here that patch accounts for VAT using the annual accounting scheme. Quite not too bad, I think, this whole business here. This is what was happening in 30th of April 2018, and now we're trying to deal with 30th of April or for the year to ending to 30th of April 2019. So this is our reference point, 36,000, right? So I need 10% of this every single month, or well, for the 9 months I'm interested in. So 10% of this gives me 3,600. So I will work with my, here we are, here's my 30th of April 2019. So I need month, I need basically the 9 months leading up to this. 1, 2, 3, 4, 5, 6, 7, 8. Well, 1, 2, 3, 4, 5, 6, 7, 8, 9. So I'm gonna start here. So this is 30th of March, Feb, January, December, November, October, September, August. So I will pay 3,600 each of these months, and I'll get here. So that'll be 3,600 times 9. Which is 0, 0, 9 times 6 is 54, 9 times 3 is 27, 27 plus 5 is 27, plus 5 is 32. So I paid 32, and then I have to make a balancing payment, and it tells me that I can make my balancing payment 2 months after this. So 2 months after that takes me to the 30th of June 2019. I make my balancing payment. My tax should be 38,000. Make my balancing payment 32,000 minus 400, and that looks like 5,600. So that's my balancing payment, and that's how we deal with this, all on one tax return. So just going back to the rules again. Here we are. Key figures there: 1.35 and 1.6. And a balancing payment is made. The annual return must be filed within 2 months of the end of the return period. So you can see there, that's how we deal with that. And the balancing payment is made when the return is filed. Cool, great, that's that. Then let's move on quickly to the next one, this cash accounting scheme. So really, this is we kind of did a bit of when we did personal tax. We looked a bit at this whole idea of cash accounting, and really the whole point here is to a certain extent, the problem really here is the fact that you usually, because when you make these sales on credit, once you send the invoice out based on the basic tax point or the actual tax point, you are now obliged to pay HMRC VAT, but you might have delays in you being able to claim VAT. So it's really a cash flow issue, isn't it? The the lack of um, if you like, the lack of correlation between having to pay VAT on cash sales, or sorry, on sales, so to speak, on credit, and being able to claim the VAT. So that's the problem that you have, really. Um, is that different? So to avoid that, there's this new one. Well, it's a new one. There's a scheme. The scheme allows the VAT to be accounted for on the basis of cash receipts and payments. So what does that mean? So businesses selling on credit do not have to pay any output VAT until they receive payment. So when we get payment from our customers, then we can um, pay the money. So not based on the invoice, but based on payment. And the same thing applies, unfortunately, therefore, that until you have paid, if you like, the money for a, something, then you cannot claim the VAT. Once upon a time, you would just send out an invoice. If you've bought something, you were sent an invoice um, before you paid it. You could claim the VAT back straight away, but now you are delayed. Input tax cannot be claimed. So in effect, what you could try and do is to try, I guess in the perfect world, you want a scenario where that you can um, bring this forward, where you pay for something, claim the money back, and you basically want to make sure you can claim your money back before you're paying. In effect, that's the kind of scenario that you want, so that you have the money in the bank, if you like, to be ready for when the customer, if you like, pays you. But that's the key point. And then in terms of the other advantage here is that this now means that you have automatic relief on impaired debts. So if you like, you can claim that money back on debts that are impaired straight away. If you like, if the person doesn't pay you. So again, the rules apply. The same rules apply to the same rules of 1.35 and 1.6 million. The same rules apply there. So basically, you must expect to sort of have 1.35 million in the next 12 months, but once you get into that bracket, you have to look back. You have to look back and ensure that the last 12 months you have not exceeded the 1.6 million. Once you exceed that, you have to come out of this scheme. Right. So that's that. I mean, this is all theory. Again, just looking at this one here, this is an interesting one. I mean, but it just kind of clarifies that. So here, of course, a business with a high level of recoverable debts, yes, straight away, you'll get your money back straight away, and the cash will come to you. Um, so let's look at this. It says a business making, which of the following businesses would benefit from joining a cash accounting scheme? So when you have a business that makes zero-rated supplies, I mean, for example, I'll just go with education, for example. I mean, you're not even charging any VAT anyway. So again, there is no real advantage there, because it's not the fact that you have to pay any VAT over to HMRC. There's just no VAT to pay. So really, this isn't really an issue, really. For you, if you're making sales to the public for cash, well, you're getting the cash straight away, so there's no problem, really. Um, there's no advantage, because you get the cash straight away and you pay the VAT. The problem really isn't it, is that you send out an invoice, then you have to pay the VAT before you get the cash from the customer. We don't have that problem here. Um, Here we have a good situation where the customers are taking on average 40 days to pay, and the company aims to pay its creditors within 30 days. So what we have here is that you are able to claim, if you like, cash in 30 days, because again, you are delayed as well, because until you pay, you can't claim. So you can claim in 30 days, so that by the time the customer pays you in 40 days, you have money available. So it'll favor this kind of delayed scenarios, where you're able to claim cash early and then only pay when you receive the money from your customers, not based on the invoice. Right, great. And then the last bit in that here is this business of the flat rate scheme, which I mean, I think it's just rather neat. Personally, I really think HMRC should just move towards something like this, because it makes all our lives easier in terms of working with VAT. And really, it literally says, listen, for really small businesses, let's look at the amounts first, the thresholds. It just says, listen, for really small businesses, if you're in this zone where your annual taxable turnover will be less than 150,000, and as long as you don't exceed the 230, let's just look at all your turnover in effect, zero rated, and just basically zero rated, exempt supplies, and of course standard rated. Let's look at everything. Forget this whole business about recovering input. I mean, again, this wouldn't work if you were heavy on the collection of, if you were the one always paying in, sorry, always claiming back. But if you look at your scenario and it looks as though you are always going to be paying you seem to be a net payer of VAT, this might work, because it means that, first of all, you can't be bothered with the administration. It might end up possibly being less VAT under the normal VAT rules, where you have to pay, and you just pay the standard rate of, I think it's 10.5%. We'll see it in a second. Oops, sorry, where are we? I thought the rate was written somewhere. Here we are. Flat rate scheme. Um, there is a percentage given. It says, oh, the relevant percentage will be given in the question. So you just look at that percentage, and we literally just do it that way. So just to kind of show you the question, here's the question. It says, Ross runs this cutlery making business. So this is these are the sales, VAT inclusive. This one, zero rated, 10, and total. And then he has purchases of 36. This includes VAT as well. So we could do it with normal rules. The 10.5 is literally saying, take the 10.5, multiply it by taxable sales of 144, VAT inclusive. Let me just be, yes, flat rate percentage of VAT inclusive, that's right. VAT inclusive, plus the zero rated of 10,000 as well, and compare that with what things would be normally. So just because of time, when I say because of time, just to show you that there's nothing unique about it, here we are. Sorry. Let me just get that right there. Sorry, almost there. Let's go. And just so you see how it operates and see how it pans out. Again, it's like I say, all administrative, but not difficult, just administrative. You just have to remember all these little admin areas and then apply them to make sure you're comfortable. Here we are. So what we have here is that this is the VAT. If you were doing it normally, you would pay VAT of 24,000, wouldn't you? And you would claim back 6,000. So in effect, you had a net payable VAT of 18 grand. But here, if we just did 10.5 of that amount, I did put it 16,170, and that makes sense. There's a benefit in going with a flat savings rate, and also you're not keeping this monthly business, and it says Ross will not have to keep records of input or output VAT, so that kind of makes sense. There's a sense there, isn't there, to doing it. Okay, great stuff. That's the end of VAT administration, and we'll come back to the final part of this and look at VAT overseas.